Hello, everyone. Happy Tuesday. It's your girl Sam here, life insurance agent, financial educator. And today is week 2 of my life insurance series. I am super excited for tonight because tonight is a really good topic. I feel that a lot of people struggle with really understanding the potential behind life insurance, which gives you some issues when it's time to pick your policy. I'm going to set the record early and say that life insurance is not a one size fits all. It is specific tailored to each individual's own personal needs. So tonight I'm just going to go over some things that you should keep in mind when you're starting to pick out a policy. I'm going to go over the different types of policies, whether you should have your child's own policy, whether they should be a writer on your policy, and most importantly, do you really need coverage after you have it through your job? So we're going to start off first with just making the air clear about the purpose behind life insurance. Life insurance is it replaces value. So any type of insurance, like if you have your phone insurance, your car insurance, your home insurance, your health insurance, it's a value placed there. It's something it will replace something. So for instance, you have car insurance in case you were in a wreck, that your car will be replaced. With life insurance, it doesn't work that you replace your life, but it's to replace your income in case anything was to happen to you, and which your family should will still be able to continue on financially. That is not emotionally, financially. And why is it so important? Because a lot of families, once their breadwinner or either the other person, the mom or the dad or the grandfather, any person that has like a figure in the household or important role, once they leave, money stops flowing in like it used to. And what happens is families are not able to reach their full capacity because they're short something. So this is why life insurance is super important, not just for the burial costs, but just for the livelihood, especially if you have small children. So it being National Life Insurance Awareness Month, I felt like it was my duty as an agent to help more people understand not just the necessity, but the potential behind life insurance. There's so much potential that you can just give generations from a simple policy, if you are educated properly on what's the right policy and how to execute it and put into place. So let's start with the different types of life insurance. So we all are familiar with the term life insurance. Term is a very popular type of insurance within our communities for many reasons. What does it do? So term basically is it's similar to like when you rent an apartment. You get a lease, you have a certain amount of time. Once that contract is over, you vacate from the premises and you get nothing and they get nothing and that's it. Well, term is similar to that in that you have a certain amount of years, hence the word term, in which you are covered. Your family is covered so that if anything was to happen to you, your family will receive a check that is income tax free, which is like, if you don't understand the magic behind something being income tax free, I want you to pull out your pay stub and look at how much taxes was taken out, especially if you live in New York. They are taking out so much taxes. But anyway, so term allows you to secure your family's financial foundation for a certain amount of years. How many years is totally up to you, and it's also totally up to the carrier you choose. Some carriers start at 10 years, some go 20, 25, some go as high as 35 years. So you can have term coverage for up to 35 years. Now, does that work for everyone? No, you can't be 60 years old asking for a 35-year policy. They're not going to do it. They usually cut it at 80. At the age 80, they start to either at age 60, the max you can get is a 20-year policy. And then if you're 70, again, 10-year policy. And then once you hit 80, if you do have a term policy, you can, depend on which carrier it is, you can continue your policy, but just know that you're going to be paying a lot of money out of pocket for that. Now, what is the benefit of having term? Like I said, you is to cover a certain amount of years. If you have small children, if you have a mortgage per se, if you have a lot of debt that you don't want to pass down to your family members, you will get a term. A term is more beneficial for you. Now, another thing with term is that you can get a large amount of death benefit for a very affordable price. So term is also attractive for that. Now, the second type of policy will be your permanent, also known as your whole life policy. Now, this is just as what it says, is permanent. So it lasts you your entire life. And if you haven't noticed, people are living a little bit longer due to advances in medication, due to better lifestyles as such. So now your whole life policy lasts to your 121 years old, which is great. So now up to 121, you'll be covered as such. Another beautiful thing about whole life, so you don't have to worry about that 80 years old, you paying a different rate. Once you get your fixed rate with whole life, that's what you pay for the entire time. Now, another beautiful thing about whole life policy is that it has cash value. Yes. So what is cash value? Cash value is similar to, like I tell people, like if you get a home and you have a mortgage and you build equity with a whole life policy, you are building cash value. Now, cash value, it grows differently depending on which insurance company you have. They all have different interest rates, usually ranging from 3 to 5%. Some of them go a little bit higher. Some years, it may be 5%. Some years, maybe 3. It may be 2. It goes down. So they keep it within a certain range. And where does this money come from? So this money comes from each year the insurance company estimates that they're spend X amount of dollars on a on covering someone, and at the end of the year they find out that, oh no, they did it with less than what they expected. That money gets reinvested back into the shareholders, because when you have a whole life policy, is normally with mutual life insurance companies, and they call them shareholders. So it goes right back to the shareholders, and that is put back into your policy, added to your cash value along with the interest on it. So that's how that's formed. Now, who is whole life great for? Whole life is great for every single person, but most people don't really understand whole life until they get older. So whole life can tend to be a little bit more expensive, a lot more expensive than term. But it's different ways, things you can do so that you can still have that coverage. So one thing you can do is you can get insurance early. If you're a parent, you can start to get insurance for your child as early as 14 days. You get insurance, you customize the policy, you have it paid off in a certain amount of time, and that's it. Another thing you can do if you're a little bit older and you're like, oh man, I see the benefit with whole life and I want to get it, you can start in increments. You can work your way up. There's convertible policies depending on which company you pick, where you can get a term policy and you can convert it over to a whole, or you can get a whole life policy for an amount, a death benefit amount that you can afford to pay monthly, and you can increase it within 5 years, 10 years, or whatever when you structure your policy to have you get to a certain amount. There's a lot of slack behind whole life insurance. A lot of people feel like illustrations are exaggerated, and your cash value can't grow as fast as companies predict it to grow. It's a lot of different things going on. My thing to you is, that you may live past 80. Well, nobody really knows how long they're going to live. It's better to just be covered, for your entire life. You don't have to go get $1 million policy with thoughts of having $750,000 in cash value grow. But as long as you have something to cover yourself, so that just to cover at least your burial costs, that would be great. The last one is universal. Now, universal is not often spoken about within different communities, because it's like it's different layers to it, and that's where it can get a little bit confusing. So with universal, is similar to a whole life, permanent life, last your whole life. You have the ability to build cash value, but with those type of policies, you can build cash value a little bit faster. And if you want to know why, is because depending on which type of universal you have, is index universal and there's variable. Index universal copies the stock market, the S&P 500, any index fund, really, but it copies mainly the S&P 500. And what it does is that it allows you to grow your money with a higher interest rate, depending on whatever the interest rate of that index fund is at the moment. The tricky thing with index is that if the index fund is not doing well, you don't get an interest rate. It'll cap at 0%. So you don't lose money, but you don't make as much money as you would, as opposed to a whole life where the cap is usually like 2% or 3%, depending on the company. The other type of universal is your variable. Now, variable, you need a security license to sell. That means you need to be a broker, a financial advisor, fiduciary, in which that is to directly invested into the stock market. So you can make a lot of money and you could also lose your policy. So that's where people get a little bit confused. So those are the three types of policies that are out there. What I often tell clients is, before you even start having a conversation about what type of policy can I get, you need to write down what it is that you want to get from this policy. Are you a parent that just wants to cover your children for the next 20 years, so that if anything was to happen to you, they'll have money to go to school, they'll have money to live? Are you a single person with no kids, just looking for burial costs, looking for a policy just to cover your burial, and then a little bit of cash value just to play in if you can? Or are you someone that's like, look, I'm young, let me take my risk, let me give me the variable, life insurance, and let's go. So this is different, criteria for each policy. So it's very important that you actually understand what your goal is behind this. Now, when it comes down to different questions, such as, well, my employer has insurance, do I really need to have my own policy? And my answer is always going to be yes. And not just because I'm an agent, because nothing is guaranteed. You can get insurance with your employer could leave. I mean, you can leave your employer and you don't have insurance, or your premiums are skyrocket. Because what typically happens with employee insurance is a group life insurance. So what it is that they get a very affordable rate term, mainly for a group price. So once you leave that group, you don't get that price anymore. So we all saw in 2020, people were losing their jobs. We see companies was downsizing, different things was going on. So just that uncertainty of not knowing that if you were to come in and they was to say you're no longer there, your benefits are gone. So it's always great to have your own life insurance policy to the side and have your employer policy be a supplement, just in case, to cover other things that, in case you were to pass away, that would cover the burial, and then your other policy would take care of the family. Now, I often get the question about children's policies, and I spoke about this when we went over whole life. Should I get my child their own policy, or should I just add them as a rider? And for many people who don't know, a rider is like a key feature in a lot of life insurance policies that can help build or stack different benefits for you. So for instance, you can get a rider to cover your child, so that in case your child was to pass away, you'll have money to bury them. You can get a rider to cover you, like an accelerated death benefit rider. If you become sick, it will substitute like a long-term care insurance. You can also get a rider that will protect your income. There's so many different riders out there, and that could be a conversation that I have for a different topic. But when it comes to your children, I'm a big advocate for them having their own policies for many reasons. One is that depending on which carrier you have, if your child is a rider on that policy, they may, at the age 25, they may no longer be covered. So that's one thing that you have to think about. Number two, once your child has their own policy, and hint, at an early age, as early as 14 days old, you lock in insurability. We all know as we get older, things happen with our health, something may come up. But once you have that policy set into place, that health that your child had when you first signed that contract is it. Like it's still signed and delivered. Whatever they contract afterwards has nothing to do with the life insurance company. They will have to pay out regardless. So you're locking in insurability. You're also using it as a way to pass down generational wealth. Now, this is something that everyone talks about: generational wealth. But most people don't know what exactly the steps are to pass down generational wealth. Life insurance is one of those steps, because when you have a policy for your child and you customize it, which is when you pay it off in a certain amount of years so that they can still have the policy, it can still be growing, the cash value and the death benefit, and you don't have to pay anything else. That's a form of generational wealth that you're passing down. You're giving your child the gift of life insurance so that if anything was to ever happen to them, they will always be covered. So I definitely am a big advocate for you picking out a policy for child, and you get it really cheap. You get it really affordable. I believe Serenity's policy cost me $300 a year. Like, she has a $300 a policy. A premium is $300 a year that I pay up front, and it's done and done. Each year you pay $300, and that's it. And that's up until 20 years. When she's 20 years old, we don't have to worry about insurance anymore. paying for insurance. She has it. She has a cash value builder for herself so that when she turns 21, she can either use that money to start a business, to help pay for school, to buy a car, to buy a house. That's what generational wealth really is. So, I hope I helped you guys out with understanding the different types of life insurance, with understanding if your employer offers it, the importance behind you still having your own coverage. It's helping you to understand why it's important that your children have their policies in place. You know, kudos to anyone that's like, well, right now I can only afford to just do the additional riders, and that's great. But as you make more money, transition over to securing your child's life insurance policy in their own. So it's your girl Sam here. I hope you enjoyed the broadcast. If you have any questions, please do not hesitate to reach out to me. Understand that when you go to pick your policy, it's not a decision that you make quickly. It's not a decision that you make without actually writing down or thinking about what your goal is with this policy. And it's not a decision you make without looking at your budget. Because what happens most times is people get insurance policies that are not within their budget, and they start to not see value in it, which forces them to look at it as a scam. Life insurance is not a scam. It is a vehicle to help you build wealth. Last episode, I spoke about how you can either build wealth, you could borrow it, or you could buy it. Life insurance gives you the opportunity to buy wealth. You can buy an enormous amount of wealth as long as you pay for it without having it lapse for your family, for the next generation. Life insurance is the potential is endless, and once you start to tap in and understand that, it will help the conversation where agents are not feeling like they're begging you to get life insurance. You're begging them to hurry up and sign you up. So it's your girl Sam here. I hope everyone has a great day, and I'll talk to you soon.